Hi and welcome everyone. I can see that there's a number of people who've logged in to today's webinar, and there's a few people still joining, but we need to get things underway because we're on a pretty tight time frame. So I'd like to welcome everyone. My name is Michael Lorimer, and as Managing Director of SISFA, I'd just like to thank you for joining us at what we hope to be the first of many webinars in our SMSF Trustee webinar series for 2018. Before we get things underway though, I just wanted to say a few words about SISFA, and in particular what our focus will be in 2018 and beyond. So I guess just who is SISFA? So we are the Self-Managed Independent Superannuation Funds Association. And I'm proud to say that we're now in our 20th year since our original formation back in 1998 as Australia's original advocacy body for SMSF trustees and their advisors. So following the successful merger with the SMSF Owners Alliance in 2017, this year we will continue to work with our members, the federal government and all of its agencies in dealing in particular with the implementation of the superannuation reforms that you'll recall were first announced in the 2016 federal budget. We're also delighted to announce the launch of our new SMSF trustee membership package, which incorporates, among other things, a first to the Australian market trustee insurance offering, exclusive to SISFA members. Our recently redesigned and redeveloped website has all you need to know about that. And with that new membership package, we'll be rejuvenating our focus in 2018 and beyond on expanding our services directly to self-managed superannuation fund trustees, including through the likes of these webinars, and as well as your advisors. So today's webinar is on the new reporting requirements for self-managed superannuation funds, which is a very hot topic at the moment. And we're delighted to have the support of Super Concepts in bringing this to you today. So it's now my pleasure to introduce our speaker, Graham Colley, who is the Executive Manager, SMSF Technical and Private Wealth at Super Concepts. Graham is a well-known figure in the SMSF community, with a long-standing reputation as an SF educator, technical expert, and advocate for the sector. Graham has held senior roles in the Australian Taxation Office and as an Assistant Commissioner of the Insurance and Superannuation Commission. Most recently, Graham was Director, Technical and Professional Standards at the SMSF Association. I'd like everyone to welcome Graham, and I'll hand over to you.
Thanks very much, Michael, and welcome everybody to today's webinar. Today, as Michael said, what I'm going to talk to you about is the new reporting requirements for self-managed superannuation funds. You need to think about this pretty objectively because many of you may not be impacted upon, by this, but you might see a lot of words in the media and a bit of hype about the fact that every self-managed superannuation fund is going to be impacted by these changes, and it'll cause a great stir and things like that. But for the majority of people, what will happen with these new reporting requirements, it's only when you're in retirement phase, and what we refer to as retirement phase is when you are drawing down a pension. So it's got to be a pension, and might do various things with that pension during your retirement phase. But in the majority, if you think of your situation, you may have been drawing down a pension on the 1st of July 2017 when these new rules commenced, and that's certainly something that impacts upon you. But the next time you do something with that pension might be some years hence. In fact, you may never need to report again because your demise might come about, and then if a pension's payable to your surviving beneficiaries, then maybe they'll need to report that pension if that's payable to them. So don't think of it as what some people think of as a bit of a crisis. It's certainly something that's fairly simple. In the vast majority of cases, the superannuation funds in accumulation phase certainly don't need to report, and it's only when people go into retirement phase that they do need to report. Now, what I'm going to cover today is what event-based reporting is, and go into that in a little bit of detail. A little bit of revision, I suppose, where we have a look at transfer balance caps, which commenced on the 1st of July last year. Talk about the transfer balance account. That's not only important for purposes of event-based reporting, but it also determines whether you can make non-tax deductible contributions to superannuation and a range of other concessions that are available. So the amount of that transfer balance account is important. Then the next thing I'll talk about is what needs to be reported, because many people think, what do I need to report? I've got amount in accumulation phase, I'm drawing down a pension from my superannuation fund. What is required and when is it required to be reported, and how do I report it? Those sort of questions I'm going to answer for you. And then finally, some things to think about. What that's got to do with is timing in the way in which some of these events may occur, or the way in which they're reported through to the ATO as regulator of self-managed super funds and the regulator of the transfer balance cap. So what is event-based reporting? Oh, okay, well, event-based reporting is that it requires certain events to be reported to the ATO because of the superannuation changes which commenced on the 1st of July 2017. And those events could be the commencement of a pension that you're drawing down out of your superannuation fund, and they're pensions that you're taking in retirement. A transition to retirement pension, which you can continue to work and draw down a pension, is not a type of pension that's required to be reported. It's only those pensions that you're drawing down after you've retired. Now, there are events where a transition to retirement income stream is required to be reported, but in those circumstances, it's only after you've retired from all work anyway. And I might explain that a little bit later. So that's the first thing. What is the event that needs to be reported? If I'm in accumulation phase, say I'm in my 40s or my 50s, I haven't retired, then by me just drawing down, me being in accumulation phase, there's certainly no requirement for me to report that to the ATO because they're not interested in that. They're only interested in amounts they count against the transfer balance cap for you. So the reporting of those amounts gets linked to what we call your transfer balance cap. Now, in the vast majority, a person's transfer balance cap will be $1.6 million. And the transfer balance account, is the amount that gets measured against your transfer balance cap to work out whether you've got an excess amount. So if you've started a pension and you've started that with more than $1.6 million, if you're lucky enough to do that, then by that exceeding your transfer balance cap, you'll end up receiving an assessment from the commissioner, the tax commissioner, and there'll be a penalty tax applied to the excess, and you'll be required to transfer the excess back into accumulation phase of your fund, or withdraw the excess out of that superannuation fund if you wish to do that. Now, the transfer balance cap is a cap on the value of pensions that can be transferred into retirement phase. So in the majority of cases, if you're drawing down an account-based pension, so it's based on the opening balance of your pension at the beginning of the year or when you commence that, then that account-based pension would be in retirement phase, and that's the cap of $1.6 million that's imposed. So, for example, if I start a pension with $1.8 million, then I'm in excess of my transfer balance cap and the value of that amount that I've started that pension with, and it's important to have a look at what I've started the pension with. That value being over the $1.6 million may be penalised for that excess. So what I need to be careful with is that the amount that I transfer to use to start a pension must, in combination with all other pensions that I've got, the value that I commence those pensions with in combination can be no more than $1.6 million. If it is, a penalty applies. Now, there are credits and debits to my transfer balance account, but that's basically the principle behind it. Now, the amount of the superannuation fund investment earnings that are exempt from tax is impacted by that $1.6 million. And what it says is that the government is prepared to go part of the way with your superannuation, and that for a value of a pension that you commence of no more than $1.6 million, the income on the investments that support that pension will be tax-free, tax-exempt in the superannuation fund. Now, it doesn't matter what that balance rises or falls to, it's the value that you start that pension with that's really important. That's what gets measured against your transfer balance cap. And as you can see on that next dot point there, your transfer balance cap, as I've said before, is $1.6 million for the 2017-18 tax year. That's the current tax year. And that gets indexed in line with CPI in amounts of $100,000. So we may not see the first indexation of this amount from 1.6 to 1.7 million dollars for maybe 4, maybe 5 years. It just depends on how inflation goes with that. Now, compliance with the ATO, with the transfer balance caps, is the job of the ATO. So what it needs to do to work out whether you're in excess of that transfer balance cap of $1.6 million, it needs to collect information from you. It doesn't collect it as part of the return process, your superannuation fund lodgement process, your income tax return for the fund or your other compliance returns. This is a separate reporting requirement, and it's more regular than, in most cases, than it would be for the income tax return, which is done once a year. So in some cases where your balance in superannuation is greater than $1 million, then there's more regular requirements for reporting. Whereas if it's less than $1 million, which I'll explain later on, then you may not have to report to the ATO as regularly. In fact, just once a year might be enough if it's a reportable event. Now, your transfer balance account. Your transfer balance account is the amount that you've transferred into retirement phase to commence pensions, and whatever that adds up to is then compared against your transfer balance cap, and if it exceeds the transfer balance cap, then penalties will apply. Now, the way in which your transfer balance account amounts when you start a pension get reported to the ATO. They're reported in what we call a transfer balance account report, which is TBAR for short. That's the one that the ATO is talking about. So a TBAR report is something that your fund administrator, or if you do all the work for your superannuation fund, you'll need to report that to the ATO when the pensions commence for that superannuation fund. Now, if you've got a MyGov account, your transfer balance account information certainly in the next year or so will be available. It's not currently available because nobody's done any reporting in relation to a person's transfer balance account, but we certainly will see that as the accounts develop and as the reporting commences. Reporting doesn't commence until 1 July this year. I mean, that's one date in which you need to comply with. Now, what amounts get counted against your transfer balance account? Now, the events that are there, if you have a look at those events, on the right-hand side, I've got the credits to your account, so that if it's the value of any pension accounts that are in retirement phase, that they are counted as a credit against your transfer balance account. So say I start a pension with $1 million, it's an account-based pension, then that $1 million will be counted as a credit against my transfer balance account. Then any other pensions that I might have had as at the 1st of July 2017, that needs to be reported as a credit to my transfer balance account. Now, as you can see, there are other things that need to be credited to your account, but they're the main things at the moment that would get credited against your account. I suppose the only other thing, if you have a look at the third point on the credit side, would be the value of a death benefit pension or a reversionary pension you get from, say, the demise of your spouse. Now, if that's paid to you as a reversionary pension, or you decide to commence a death benefit pension, then the value of that pension at the time it commences will be counted against your transfer balance account as a credit. But as I said before, the vast majority of people will have the value of pension accounts as at the 1st of July 2017 and the commencement value of any new pensions that they commence. Now, on the debit side of things, this reduces your transfer balance account. I suppose the most common thing there would be what we call a commutation of the capital value of the pension. Now, that's whether you commute or convert the value of your pension in full or in part to a lump sum, and you might want to transfer part of that pension account to accumulation phase in that superannuation fund, or withdraw the amount as a lump sum. Now, there's certain strategies that certainly work there. That is, by drawing the minimum pension that you've got, you're making sure that you keep your pension account balance as high as possible. And if you want to take more than the minimum pension, then you may find that it's better to commute that part of the pension to a lump sum, because the commencement value of that pension would have been recorded as a credit. And if you convert part of that pension to a lump sum and draw that out, then that's a debit to your account and actually reduces your account. Now, if you have a look down the bottom of the slide, things like pension payments, investment gains and losses that get added to or reduce your pension balance don't give rise to any debits and credits, as you'll notice. So that what happens there is that if I've started a pension, I've decided to draw down a pension amount, and then maybe I've got some income there on the investments to support that pension, they won't impact upon, and they're not required to be reported as part of the transfer balance account arrangements with the ATO. It's only if I decide to commute the pension, convert part of it to a lump sum, do I need to report that to the ATO, so that'll decrease my pension balance in those circumstances. So how do I report the amounts to the ATO? Well, there's three possible methods to report. There's a paper form, which you can certainly get off the ATO website. Even now, that's available. You can complete an online form if you want to do that, and that's probably what most self-managed superannuation funds will be doing. And the last one is a bulk data upload, and the bulk data upload is principally there for the large superannuation funds like industry funds and retail funds and so forth, and they will report regularly to the regulator on all the reportable amounts in relation to their fund members. Whereas with a self-managed fund, you've usually only got 2 members. On the odd occasion, you might have 3 or maybe 4 members. So it's relatively easy to fill out the online form or the paper form and get that off to the ATO. So every debit or every credit that's required to be reported needs to be put on that paper form or the online form and get that to the ATO. Now, at the moment, 4 events for a particular member can be reported on both the paper and the online form. And it's only when an event's to be reported, as I said before. So if I've started a pension in the last year and I don't intend to do anything further, I just keep on drawing down that pension, then all that will be reported is the value of that pension when I commence it. And that's probably the last time I'll ever need to know about the amount being reported to the ATO. But in some cases, I might commute that pension if I need to do that, and various things like that. Now, what gets reported? Not only do you need to report the debit or the credit, as I've indicated before, but what also gets reported is that information to identify who you are and how that links up with your account. So there's as you would usually see in reporting to a regulator, the name, tax file number, date of birth, residential address, those sorts of things. Then some provider details, who the superannuation fund is. So that might be, the John Smith Superannuation Fund, which might be a self-managed superannuation fund. And then the event details. It might be the commencement of a pension. It might be the value of a pension on the 1st of July 2017. It might be the commutation of a pension. So when did that occur and what was the value of the amount? So I might have started a pension with $1 million. So I'll say I've started a pension. It occurred on the 1st of July 2018 and the value was $1 million. So they're simple information. And then, of course, each income stream will get a unique identifier. Now, in many cases, administrators will give the pensions that you might be drawing out of a fund. Say you're drawing more than one pension out of that superannuation fund. I know the way in which we do it, we've got account-based pensions 01, 02 and so forth in relation to the pensions a member might be drawing down out of that fund, just to make sure we've got consistency in that pension and how it's treated and how it gets reported to the ATO. So when is it reported? This is the important thing, and as I'll continue to talk, you'll find that if you're using an administrator, the administrator usually would include that as part of the service that they provide. And I did get one question where somebody asked me whether administrators would charge for the additional information being reported to the ATO, because it's separate, as I've indicated, from the income tax return and other compliance returns. So will an administrator add to the cost of the administration of the fund? Well, the answer I've got is it just depends. Some administrators may increase the cost of administering the fund. I know we and a number of others are certainly not going to do that because we see that as part and parcel of the administration service we provide. But some others who may not have access to automatic systems there, such as automatic administration systems, they may end up filling out those forms. That might take some additional time and they may include an additional cost for that. But I think what you'll find, because of the competitive pressure on the administrators at the moment, you may be lucky to see any increase in the cost of that administration service simply because of this type of reporting, because they've got that information. There might be a few things that you might need to get the information through a bit more efficiently than we probably have in the past, and that's not a criticism. It's just the way in which we'll need to pick up our game a little bit to make sure that the reporting to the ATO helps with a more timely administration of the fund. Now, when are these events reported? Now, when the fund's required to report those events that I've talked to you about before by using what's called the transfer balance event notification. It's just a form, you fill it out, and that information that I've referred to in that last slide is there. Now, for the bigger superannuation funds, if you're a member of an industry fund, they'll be required from the 30th of November this year to report within 10 days of the end of the month in which the event occurred. So if I started a pension, say, in November 2017, then maybe by the 10th of December, in the December reporting that I would have had there, that information will have to be reported to the ATO. Now, when you have a look at self-managed superannuation funds, there's concessions there for self-managed superannuation funds. So there's a universal concession for the 30th of June 2017 existing pensions. So that on the 30th of June 2017, I would have had to have a look at the pension I've got in that superannuation fund, work out whether all the values of my pensions as at that time was greater than $1.6 million, and then make an adjustment to get the total balances of all of my pensions down to $1.6 million. So what I need to do, I need to report to the ATO what the value of those pensions is as at the 1st of July. Now, that's important because if it exceeds my transfer balance cap, I could end up with a penalty. So I've made that adjustment. I know I need to report that, but I don't need to report that immediately because I don't need to do that until, or I think I can do it now, but I don't need to do it essentially prior to the 1st of July this year. So that's, if you think about that and the bigger superannuation funds, there's a little bit of a mismatch there with the reporting that's going on. And that's one thing I'll talk to you a bit later about, because if you've got a self-managed superannuation fund and you've got the pension balance in another fund, a larger superannuation fund, you may find that the APRA fund, the industry fund or the retail fund of which you're a member has already reported something, whereas the self-managed superannuation fund, because of the way in which the reporting works for them, may not be reporting for a little while after the bigger funds, and there might be a bit of a mismatch there. So that's something you really need to keep an eye on to make sure there's no mix-up when you're a member of a big fund and also a member of a self-managed superannuation fund. So the other reporting standards that are there are that for self-managed funds, it's to report some events 28 days after the quarter in which the event occurred, or when the fund lodges its annual return. And that depends on your total superannuation balance at the time, in the first financial year in which you draw down that pension. Now, that's a really important thing to understand, because do you report 28 days after the quarter in which the event occurred, or do you need to, or can you hold out until the fund's annual return is lodged, which may not be until the 15th of May or even later in the subsequent financial year. So that's certainly something you need to have a look at in relation to that. Now, let's have a look at the total super balance test, because the total super balance, I've talked about transfer balance cap, I've talked about the transfer balance account, and this test for reporting to the ATO is based on your total super balance, and there's a test there. Now, what that test is that it determines when the self-managed fund needs to report to the ATO at its latest. And why I say at its latest is that if you do have other benefits in other superannuation funds and you're drawing down pensions in those other funds, you may find that they've reported and you want to know the most up-to-date information in relation to your total superannuation balance and what's been reported to the ATO, then it may be better to report as soon as the event happens or quickly thereafter, rather than to hang out and wait until 28 days after the end of the month or when the fund lodges its annual return, which can be well down the track after the event has occurred. So the test is that if your total superannuation balance is at least $1 million, then the fund, your balance, any event that happens to your superannuation, you commence a pension, you commute it, you might be in receipt of a death benefit pension, then that needs to be reported. That event needs to be reported on a quarterly reporting cycle. So that's 28 days after the quarter in which that event occurred. And that's only where you've got a balance of more than $1 million. If you've got less than $1 million as your total superannuation balance and you start a pension or one of those events, then you don't need to report that until the annual return for the fund is lodged. Now, subsequently, those rules will continue irrespective of what happens. So if you decide to increase your total superannuation balance, you make more contributions to superannuation, or you then have got a money in accumulation phase and you start a new pension with that, you'll find that for you, if you start off in the first year with your balance is less than $1 million, going forward all the time, if any events are required to be reported, they'll be done when the annual return is to be lodged by the fund. Whereas if you've got a balance of more than $1 million in the first year in which you start that pension, then you'll always be required to report on that quarterly basis. So there's some consistency there, even though it might sound a little bit confusing at least there's some consistency. Once you start reporting on one basis, that'll continue going forward for the self-managed superannuation fund. So that's the important thing. When do you report? If you've got a good administrator, or you're using an accountant or an administrator who uses a particular system, they'll be able to determine what those balances are and hopefully work out the consistency in the reporting that's required to go through to the ATO. Now, for the 2017-18 year, that is this financial year, if certain events happen in your superannuation fund, then this is the way reporting will take place. And that is by the 1st of July 2018, if I had a pension balance as at the 30th of June 2017, and I was drawing down that pension on the 1st of July, then I need to report to the ATO what my pension balance is by the 1st of July 2018. So hopefully your administrator will be doing that for you by or before the 1st of July this year. Now, if you decide to commence a new pension, just depending on what the balance of that, what your total superannuation balance is, then the first time you'll be reporting is 28 July 2018, because the first quarter, or the first time you'll need to report these amounts, even though you might be on a quarterly cycle, is by the 28th of July 2018. Or if your total superannuation balance is less than $1 million, the due dates there is when the superannuation fund, when your self-managed fund lodges its 2017-18 annual return. So that's an important consideration, because what I might have done, I might have had a pension balance as at the 1st of July, maybe that was $1.4 million. I know that I need to report I know that needs to be reported to the ATO by the 1st of July 2018. But I might have partially commuted. Maybe I've drawn down a lump sum of that pension. So by the 28th of July, the amount of that commutation needs to be reported to the ATO. So I've had two events which require reporting. The first one is that pension balance by 1 July 2018, as at the pension balance on the 30th of June. And the other one is the commutation of that pension. So that'll be a debit to my account, whereas the pension balance will be a credit to my account. Now, where commutations are required because you've exceeded that $1.6 million cap, as you can see down on the bottom of that table, you've got to do that within 10 business days after the end of the month in which that commutation request has come from the ATO. So these are different to decisions you've made. This is something the ATO's found out. It's come across your superannuation arrangements. It said you've exceeded your transfer balance cap of $1.6 million. There's a penalty that applies. And in those circumstances where I've got what we call a determination from the ATO, I know I need to, or the fund needs to report to the ATO within 10 business days after the end of the particular month. Now, we won't see those coming out from the ATO for some time, simply because of the way in which your fund won't be reporting until at least the 1st of July 2018, or there's no compulsory requirement there, or subsequent to that time. So let's have a look at a little case study. We've got Jane, who commenced an income stream in October 2016. Now, at that time, there was no rules there applying to Jane's pension. She could start the pension with as much as she wanted to. Now, let's assume that on the Jane's total super balance on the 30th of June 2017 was $800,000. Now, because that was less than $1 million, then we know that there's no requirement to report that amount until the superannuation fund lodges its tax return. So Jane decides to commute her pension in November 2018. Now, what's required to be reported and when is it required to be reported? So we've already seen the $1 million total super balance requirement, and the commutation will mean there's a debit to Jane's account in those circumstances. So the income stream that commenced in October 2016, the balance of the superannuation fund as at her pension as at 1 July 2017 will need to be reported to the ATO by 1 July 2018. and that's assumed that the pension the balance on the 30th of June 2017 was $800,000, less than $1 million. Then Jane commutes her pension in November 2018, which means that that will be reported in the fund's return when it gets lodged. So that's what will happen in Jane's case in that situation. Now let's have a look at this one. That is, let's assume that Jane had a total superannuation balance as at the 30th of June of $1.1 million. She's got that pension coming out of the superannuation fund. We know that that needs to be reported. The balance on the 1st of July 2017 needs to be reported to the ATO by 1 July 2018. And then, as we know, Jane commutes her pension. So that needs to be reported by 28 January 2019 because we've got the November commutation, and 28 days after the end of the quarter is the 31st of December 2018, 28 days after that is the 28th of January 2019 is when that commutation is required to be reported to the ATO. Now for the 2018-19 year, that's for the financial year that begins on the 1st of July this year, as we can see, there's some slight changes there. New pensions, 28 days after the end of the quarter. Partial commutations, same, you go onto the quarterly basis there. Or ceasing a pension, they're 28 days after the end of the financial quarter, or where that balance was originally struck at less than $1 million, the total superannuation balance. Say that was Jane's case, that would have been in the $800,000 that she had as a balance on the 1st of July, then that would coincide with the reporting when the annual returns required. But if her balance is greater than $1 million, as in the assumption there we made of $1.1 million on the 1st of July 2017, then the report for any event there would be 28 days after the end of the quarter. Now the commutations, that won't change. The commutations to rectify the transfer balance excess, because it's greater than $1.6 million, will be required within 10 business days after the end of the month in which the ATO has set out a determination. So that's an important thing. If you've got something from the ATO, it says you've got an excess over your transfer balance cap, you'll need to do something with that transfer balance cap. That is, transfer the excess to accumulation phase or draw the amount out as a lump sum from the fund, and you need to report that pretty quickly after the end of the month, within 10 days after the end of the month. Now you might think, now my accountant tells me at the end of the financial year or whenever we're preparing the return, roughly what the balance is for my pension. But when I look at these reporting requirements, what that'll require me to do is to bring forward the reporting, if I'm not using the annual return arrangement, 28 days after that quarter. So if I start a pension now, I'm looking at the March quarter, I'll need to report that 28 days after the March quarter if that happened, if I was required to do that, say this time next year. So in those cases, you think, well, I don't really know the value of my pension. I don't do my accounts until the end of the year. I'm on a yearly cycle with my accountant. Do I have to exactly know the balance? Well, it's pretty handy if you do. But the ATO said that providing you've got a reasonable estimate of the value of the pension, you start a pension partway through the end of the year, or the year, or you finish it at the end of the year, then a reasonable estimate is accepted. And there's some factors you take into account, whether you've done that in good faith or whether you've manipulated the numbers. If you've manipulated the numbers, the ATO might have a second look at it. You're using a reasonable process, so maybe the opening balance, adjusting that for estimated dividends that have come into the fund during that period to just make a reasonable estimate of the value of the pension. Now, if you have a look at the ATO's valuation guidelines for assets and CGT purposes, in some cases you might be using the value of a particular asset at the beginning of the financial year, whereas with other investments, they might be the last night's value, say in the case of maybe publicly listed shares. But maybe property, you might want to use the value at the beginning of the financial year. So you might have all different times when you're valuing the particular assets, but providing that's reasonable, then the ATO is quite willing to accept that as a reasonable estimate. So I hope you've worked out by now that there could be some risks associated with annual reporting if you leave that until the last minute. That is, if you're leaving it to the 1st of July 2018, or when the tax return is lodged for the superannuation fund, and then you're reporting through to the ATO, and then they're recording those amounts on their system. Now, why I say that is that, as you can see, the APRA-based funds, the biggest superannuation funds, will be reporting at the end of the month, each month. Self-managed superannuation funds, depending on your total superannuation balance, may be reporting at 28 days after the end of a particular quarter, or they might be reporting when the fund return for the fund is being lodged. So by you holding out until you're absolutely required to do that, if you've exceeded the cap, that $1.6 million cap, you may find that you get a determination from the Commissioner when you think, wait a minute, those calculations from the Commissioner have been mucked up because of the timing in which the amounts have been reported to the Commissioner. So by getting them quickly into the Commissioner, at least hopefully you'll see some much more accurate reporting in the way the Commissioner's seeing your superannuation balance. But as I said before, there may not be very many times at which you need to report these amounts, the events, to the Commissioner, because there may only be one event, and that could be the commencement of that pension in your case. So what I think the risks associated with late reporting are is that the data on MyGov may not be out of date. In fact, if you're not reporting that information until the return for the superannuation funds lodged, and that can be 18 months or more after the end of the financial year, then you'll have something reported then, yet the event took place, 18 months or more prior to the time the Commissioner finds out about that event. So maybe reporting earlier could work out. Deemed earnings calculated on that, if you've exceeded that $1.6 million cap, is from the date of the event rather than from the date you report it to the Commissioner. So that can certainly add to the cost of any determinations and any additional tax that could be payable. And then you might end up, if one fund you're a member of, say an APRA-based fund, reports prior to the self-managed fund, so the commutation or the rollover of that pension, you may find that an excess determination gets issued to you, which could be incorrect. So you may need to keep your own records, or making sure the administrator is up to date to make sure you don't end up with double counting. Now you might say, well, I'm looking at this, what does the ATO think of that? The ATO certainly appreciates, because of that different timing in the reporting, that you could end up with some double counting there, and they certainly will be aware that some adjustments will come through. You might need to object against that determination to have the correct amount counted against your assessment. So that's probably one thing that you need to think about with your superannuation fund, making sure those records are up to date, they're much more timely, and the way in which you report to the regulator, particularly if you're a member of an APRA-based fund as well, you need to make sure that the self-managed fund reports are pretty well up to date, so you don't get caught out by getting an excess determination from the ATO. Now let's have a look at the last little case study here just to finish off. James and Ava are in retirement phase. That means that they've retired and they're drawing down a pension. Their pension balances are both less than $1 million. Now, on the 30th of June 2017, their total superannuation balances are $900,000 and $800,000 respectively, which means that the fund doesn't need to report their the information, the retirement phase pension balances, until the fund lodges its return for the 2017-18 financial year. And that may be in May 2019. So it can be a fair way down the track. So now, they've both made a number of lump sum withdrawals from their pensions. So we know that they're in retirement phase, they've needed to report those balances. They're less than $1 million. They don't need to report that until the tax return for the fund's lodged. Now, by drawing down a number of lump sums means that every time they draw down a lump sum, they've got to report that within 28 days of the quarter in which that lump sum has been withdrawn. So what that means is that they're reporting the withdrawals of the lump sums prior to the reporting of the pensions, which isn't required to be done until the tax return for the fund's been lodged. So you've already got that mismatch there. Now, unfortunately, James dies and his death benefit pension is what we call a reversionary pension, and that's automatically payable to Jane. Now, in those circumstances, there's a 12-month leeway before that needs to be reported to the ATO. So there's a 12-month time after James's death that the ATO will be advised that Jane's now in receipt of a reversionary pension, and therefore that gets counted against her transfer balance cap. So the withdrawals don't have to be notified to the ATO when James dies. It's a little bit later. And so you've got this mismatch there. So in Jane or her advisor's situation, they need, in those cases, to do their own calculations rather than to rely on what's on the MyGov and what has been reported to the ATO, simply because of that timing. So hopefully the accounts for the fund are kept up to date in those circumstances. Okay, well, that's my presentation. Now, we've got some questions that have come through. Now, Liz has asked the difference between SISFA and the Self-Managed Superannuation Funds Association. Okay, so I might pass on that one. Okay. Now, the anonymous attendees come back and said to me, do you think there will be any changes to the new reporting requirements, and do you have any idea on how many funds will be affected? Having a look at the numbers of self-managed superannuation funds that are paying pensions at the moment, it would be around about 25 to 30% of all funds are paying pensions. That's information that I would have. So that around about 1/3 of self-managed superannuation funds would need to report this information. Now, we don't know what the aggregate balances there are, so we don't know whether those people would have balances of greater than $1 million or less than $1 million. So whether they need to report 28 days after the end of the quarter or by the time the fund lodges its tax return. You would expect for the majority of funds, for self-managed super funds, that they would be holding out until the fund lodges its tax return. So that's that. Now, Roger's asked, if I die and a reversionary pension greater than $1.6 million is paid to my wife, does my wife have to report the excess amounts in her name by 10 days after the next month? If I die on the 30th of the month, does she have 10 days to sort out the situation only? Okay, Roger, in that case, if your wife becomes entitled to a reversionary pension, because it's a reversionary pension, it doesn't have to be reported until a year after, or it doesn't get measured against your wife's transfer balance cap until 1 year after your death. So in that case, it's a year after you're passed away that is required to be reported. So it's not 10 days after the month in which you die. You get quite a leeway there. However, if it's not a reversionary pension and your wife has got a lump sum there and she's deciding whether should I take it out of superannuation as a lump sum or should I commence what we call a death benefit pension, then as soon as the death benefit pension starts, then 28 days after the end of the quarter in which that pension started is when that death benefit pension is required to be reported to you. Now, Errol's asked, can you provide a case study where the total superannuation balance exceeds $1.6 million, say $2 million? Okay, well, I can't. What would happen in that case? Hopefully by the 1st of July, if the pension was payable by the 1st of July 2017, you've taken the opportunity to reduce that $2 million balance down to $1.6 million. You've either transferred that into accumulation phase or drawn it out as a lump sum, so you won't exceed the balance. But say, for example, you start a pension with that $2 million by mistake. You're not aware of what the rules are, and you start that, say, today. Okay, with that, because your total super balance exceeds $1.6 million, you're drawing down a pension with all that money, that is that $2 million. That will require reporting to the ATO on the 28th of July, that $2 million. It will go to the ATO, it'll record that on its system, and it will write back to you with what we call a determination and say, listen, Errol, you're in excess, that pension is in excess of your balance by $400,000. You've got to commute that pension, get it down to $1.6 million, and because you breached the rule, you're greater than 1.6, there's an interest rate penalty payable upon that. And that needs to be reported to the ATO. So you need to get back to the ATO within 10 days after the month in which you get that determination and tell them that you've got to reduce your pension balance down to $1.6 million, and the ATO will record that on its system. So we've got still have the anonymous attendee has asked, I still don't have any understanding of the position. So what position is that when it's reported on the reversionary pension? Well, where you've got a reversionary pension, you've got a 12-month leeway there before it's reported for transfer balance cap purposes after the death. Now, Robin's asked, what if this is the situation if, as of today, our administrator is not commuted to accumulation funds over the $1.6 million? I'm waiting for the administrator to do that. Now, I assume there, Robin, that the administrator is in the position that they're preparing your accounts for the 2016-17 year. What you will find, as we're doing at the moment with our clients, is we're preparing their accounts. And what we'll be doing, we would be adjusting your pension balance as at that time. So we'll be indicating that your balance is no more than $1.6 million on the 1st of July in the accounts, and that is sufficient for the ATO, even though it's taking place. Yeah, so you're waiting for the accounts. So, yeah, we've got a lot of clients here, and I'm sure a lot of accountants and administrators are preparing accounts at the moment. So what will happen is that when you get the accounts, it will show the accounts for 2016-17 that your balance in your pension account there will be no more than $1.6 million, and there'll be a transfer of amount to accumulation phase, or you may have withdrawn the excess out of your superannuation fund. But most people, if they're in that situation, will be transferring an amount over to accumulation phase. Now, one more question. The other questions I've got, I will answer in writing to you, and I'll send them via SISFA. Now, Ewan has asked, if I have a total if I have a total balance account of $2 million and $1 million in an account-based account-based pension in accumulation, $1 million, and choose to pay $500,000 from the accumulation as a lump sum, am I correct? There is no reporting requirement because it does not affect the transfer balance account or pension account. If you've got an account-based pension of $1 million there, then it will still require reporting, but that reporting will occur at the time of the, or it depends on what your total super balance is on the 30th of June in the previous year. So in your case, it seems that on the 30th of June in the previous year, that you'll have an account total balance in superannuation of more than $1 million, and therefore you would be required to report 28 days after the quarter. I'll have a closer look at that, and I'll certainly answer that in writing for you. But thanks, and I'll get all those questions and I'll get an answer out in the next few days for you. Okay, so that's the end of the presentation. Thanks for listening in, and I hope that's given you some idea of the event-based reporting the ATO's got in place, and hopefully gives you a bit more of an insight that it's not a great panic as some people may think it is. Thank you.